Welcome to our channel. Today, we're delving into the fascinating evolution of capitalism and the pivotal moment that forever changed the global economy, the end of the gold standard. But first, let's take a journey back in time to understand the origins of capitalism. At its core, capitalism is an economic system where private individuals own the means of production and operate for profit. It's characterized by free markets, private property rights, and minimal government intervention. Capitalism has a rich history, dating back centuries to the emergence of mercantilism and early trade routes. But it wasn't until the Industrial Revolution that capitalism truly took hold, transforming societies and economies around the world. With the Industrial Revolution came unprecedented technological advancements and the rise of factories, leading to increased production and wealth accumulation. Capitalism thrived on innovation, competition, and the pursuit of profit. Fast forward to the late 19th and early 20th centuries, and we arrive at the era of the gold standard. Under the gold standard, currencies were backed by gold reserves, providing stability in international trade and monetary systems. In the 19th century, the British pound sterling reigned supreme as the world's primary reserve currency. The dominance of the pound sterling was rooted in the economic and imperial strength of the British Empire. Britain's extensive colonial holdings, robust financial institutions, and formidable navy bolstered confidence in the pound as a stable and reliable currency. Under the gold standard, countries pegged their currencies to the pound sterling, which itself was convertible into gold at a fixed rate. This fixed exchange rate regime facilitated global trade and investment, providing stability in international finance. When World War I broke out in Europe, it weakened confidence in the pound sterling, while the United States emerged as a dominant economic and geopolitical power. Financial instability during the interwar period further eroded trust in the pound, necessitating a more stable reserve currency. The United States initially remained neutral in the early years of the war, benefiting from its geographic distance from the European theater of war. The outbreak of World War II hastened Britain's decline and solidified the US dollar's position as the preeminent global currency. The Bretton Woods Agreement formalized this transition, cementing the US dollar as the world's primary reserve currency and making the shift from the pound sterling inevitable. The Bretton Woods Agreement, established in 1944, was a pivotal moment in global economic history. Amidst the rubble of World War II, representatives from 44 allied nations gathered in Bretton Woods, New Hampshire, to forge a new path forward. Out of this conference emerged two groundbreaking institutions, the International Monetary Fund, IMF, and the World Bank. Together, they aimed to stabilize economies, facilitate reconstruction, and foster international cooperation. At the heart of the Bretton Woods system was the pegging of exchange rates to the US dollar, which itself was fixed to gold at $35 per ounce. This arrangement provided stability in international trade and finance, crucial for the rebuilding of war-torn nations. The agreement was born out of necessity. The devastation of the war left economies in ruins, and the specter of the Great Depression loomed large. The Bretton Woods system aimed to prevent a repeat of past economic crises by curbing competitive currency devaluations and promoting stable monetary relations. By facilitating international trade and investment, the Bretton Woods system set the stage for the post-war economic boom and the rise of globalization. It laid the foundation for decades of economic stability and prosperity. While the Bretton Woods system eventually collapsed in the early 1970s, its legacy endures. The IMF and World Bank continue to play vital roles in the global economy, and the principles of international cooperation and economic stability that emerged from Bretton Woods still guide policymakers today. Countries adhering to the gold standard agreed to exchange their currency for gold at a fixed price, ensuring that the money supply was tied to the limited availability of gold. In 1971, President Richard Nixon made a historic decision that forever changed the global economy. Faced with mounting trade deficits, a depletion of U.S. gold reserves, and speculative pressures on the dollar, Nixon announced the end of the gold standard. This decision, known as the Nixon shock, suspended the convertibility of the U.S. dollar into gold, effectively dismantling the Bretton Woods system of fixed exchange rates. The move was driven by a desire to regain control over domestic inflationary pressures, provide greater flexibility for monetary policy, and address concerns about the sustainability of the international monetary system. However, it also marked a significant turning point in the global economy, leading to increased currency volatility and uncertainty. The end of the gold standard paved the way for the transition to a system of floating exchange rates, where currency values are determined by market forces rather than fixed to gold or other commodities. While Nixon's decision provided short-term relief for the U.S. economy, it also set the stage for a new era of globalization, with far-reaching consequences for capitalism and international finance. Nixon's decision, known as the Nixon shock, effectively severed the link between the U.S. dollar and gold, ushering in a new era of floating exchange rates and fiat currencies. The end of the gold standard marked a seismic shift in the global economy, with far-reaching consequences for capitalism and international finance. Without the constraints of the gold standard, central banks gained greater flexibility in conducting monetary policy, leading to increased inflationary pressures and currency volatility. At the same time, the world witnessed the rise of globalization, as barriers to trade and capital flows were dismantled, leading to increased interconnectedness and integration of economies. Today, we live in a world shaped by the evolution of capitalism and the end of the gold standard. While capitalism continues to drive innovation, growth, and prosperity, it also faces new challenges and criticisms in our ever-changing global landscape. With the constraints of the gold standard removed, the global economy has now entered uncharted territory. Let's explore how this can impact capitalism and the total money supply. First, the lifting of the gold standard grants central banks greater flexibility in managing monetary policy. They can now adjust the money supply to stimulate or cool down the economy as needed. However, this newfound flexibility comes with risks. Without the discipline of the gold standard, there's a danger of currency devaluation and inflation if central banks print money excessively. Moreover, the absence of a limiting factor on the money supply could exacerbate income inequality and fuel asset price inflation, potentially leading to speculative bubbles in financial markets. On a global scale, the lifting of the gold standard may contribute to economic imbalances and trade tensions, as countries vie for dominance in the international monetary system. The 2008 financial crisis saw the collapse of major financial institutions, a housing market crash, and widespread economic turmoil. In response, central banks around the world engaged in unprecedented money printing and stimulus measures to shore up financial markets and prevent a total economic collapse. While these measures helped stabilize the economy in the short term, they also raised concerns about the long-term consequences of unchecked money supply growth. In late 2019, the pandemic unleashed another wave of monetary stimulus. Governments and central banks responded with massive money printing and fiscal stimulus packages to support struggling economies. While these measures provided much-needed relief to businesses and individuals, they also fueled inflationary pressures and raised questions about the sustainability of current monetary policy. The risks of unrestricted money supply growth are clear. While monetary stimulus can provide short-term relief, it also carries long-term consequences for inflation, currency stability, and economic growth. Inflation erodes purchasing power, currency devaluation undermines confidence in financial markets, and financial instability poses risks to global prosperity. As we navigate the complexities of modern finance, it's essential to learn from history and strike the right balance between monetary flexibility and stability. Thanks for joining us on this journey through the evolution of capitalism. Don't forget to like, share, and subscribe for more videos exploring the fascinating world of economics and finance. Until next time, stay curious.